Hello, this is Doug Marshall, and for this short session, what I'm going to do is just walk through a life insurance calculator that happens to be on a good website for insurance. It's a nonprofit organization called Lifehappens. They have a life insurance calculator, and we're going to be focusing in on that specifically. You can see that here we have insurance needs, disability insurance needs, and a thing called human life value. But for this particular session, we're going to focus in on the life insurance needs calculator. And I'm going to do it, though, from my iPhone because it's got a handy app, so it's always with you. And I just wanted to show you how simple it was. In addition to that, we're also going to take a look at the underlying calculation for how they figure out how much insurance you need to generate a stream of income over a period of time, which is the most complex calculation that these calculators work with. They're not overly complex, but I think it's good to understand the underlying workings, because I find that if you don't see that stream of income and you're only seeing this is how much insurance you need, then it becomes a little bit confusing to relate that big number of insurance to the stream of income. You'll see what I mean. So I'm going to flip over to my phone, and this is the app that I am talking about, the one right here that says Life Happens. I'm going to go there, and I'm going to go to the calculate your needs. So this is the landing page, and this is the calculating your needs. And I'm going to go through a typical example, but I'm going to leave out most of everything except the income need, and you'll see what I mean. And then you can go and get the life insurance needs calculator and work it through yourself, entering in some information that's a little bit more specific to you. So it's really a 5-step process, and then we're going to go to a spreadsheet and see how these numbers are derived. So the first thing to do is we want to just put in some basic estimated family expenses that would happen at the time of death. Since I don't want to deal with those right now, not that they aren't important, I'm going to get all of those out. We're not going to consider college educations or outstanding mortgage. I want to focus in on this second spot, which is the total annual income needed. And I'm going to calculate for $100,000 for 20 years, just to use a round number and make this presentation easy to follow. So it's $100,000 of income. I want to solve for 20 years. I am not going to assume any current savings or retirement savings or current life insurance. I just want the raw number. And then you can also put in spouse's income, but I'm going to leave that blank as well. And then finally, as you scroll down here, we look at the extras, and we're going to assume in this case an inflation rate of 2%. One of the things I did notice from the app is that you can't put in 2.5%. That might be different than the website, but I did not find that to be true here. So I'm using an estimated inflation rate of 2%, and then I'm using an after-tax net investment yield of 4%. So you can play around with these numbers and see how it impacts the ultimate insurance amount. So very quickly, we can hit on the analysis button down here, and it pops up with this number of $1,673,000. That's how much they're saying you're going to need in order to generate $100,000 of income per year, assuming 2% inflation, so it's adjusting for inflation, at a net after-tax investment rate of 4%, which is fairly conservative. And as you scroll down, you can see how these numbers work out. We didn't assume anything else into this calculation. We did show the $100,000 for 20 years, 2% inflation, 4% after-tax net investment yield. And it says you're going to need $1,673,000 for that stream of income. So now I'm going to take you to a spreadsheet that shows you, excuse me, that shows you how this calculation is done. And it's interesting to take a look at what goes into the calculation of this number. So here's the 2% inflation rate. Here's the 4% investment rate. And I've entered in the amount coming from the calculator, the $1,673,000. The income that we need is starting at $100,000, but remember we threw in the 2% inflation. So this is what's happening in the calculator that you don't see. Each and every year, it's assuming that the amount of money that you need to take out of your capital account, which is your life insurance proceeds, you would need to take out more and more each year to make sure that for the same goods and services that you want to purchase each year, you're not having to, you've accounted for the increased cost for these goods and services. I'm not saying 2% is the right rate to use, but this is just the example that I'm giving you. So if you run it all the way out to year 20, you would need $145,000 in year 20 to buy what $100,000 purchases today. I think a lot of people have a good feeling for how that works. But here's how the calculator works, and here's a few comments on that. So in the first year, I have the $1,673,000. And in this case, this calculator is assuming annual withdrawals from that amount. So just one time right up front, put it in the bank and then spend it. So we have the $1,673,000. We take out from that in the first year the $100,000 to provide the income. And then at the beginning of the year, that means that we have $1,573,000 working for us, but it's grown at 4%. And so that will take us back up to $1,636,000. Now, as we proceed, we are going to take from that $1,636,000 $102,000, which will then leave us with $1,534,000 to earn interest at 4%, which grows to the $1,595,000. So as we go through this process of taking money out of the capital account and having interest added to the capital account as it earns, you can see that the value of the capital account is going to continue to decrease, because what we calculated this for was to only have 20 years of income. We were going to invade both the interest earnings on the account and the principal, and that principal amount reduces so that at the end of 20 years, there is no more capital left to generate any income, and that's the stream of money that we've generated. So this calculation out of the calculator is correct because I've checked it off of the spreadsheet, but I wanted to point out that you probably wouldn't need to calculate as much capital account initially if we were doing this on a monthly basis. I can go into that on a separate session, but if you were only taking $8,333 out in the first month, you would have more available to earn interest at the end of the first year. And so this end of year number that you see here at the end of year one would have had more interest added to it. So it would be a greater number than $1,636,000. Hopefully that makes sense. But as I examine this calculator, it does a pretty good job of getting you to a number or giving you a basic understanding of what happens when you have to pay off a mortgage, when you assume different rates of inflation, investment rates, length of time that you would need income to stick around. This will give you a lot of basics. It's not perfect, but I think it's very adequate. So I just wanted to leave you with that. I think that's a very good analysis and a good start. I think that this website is very helpful. It's independent. You can get life insurance calculators from a lot of different financial resources, whether they be insurance companies or financial planners. They all would probably do pretty much the same thing for this basic calculation. Thank you very much for listening. And if you have any questions, you can call me, Doug Marshall, at 206-605-4695. My email is also jdougmar@splan5.com. Have a great day.